BizB, the insight you need. I'm Junfeng. China's second quarter GDP growth rate was 0.4% from previous year. It was announced on Friday. That's weaker than the market forecast of around 1% and was the slowest since the first quarter of 2020, when China's economy was hit by the coronavirus pandemic and contracted 6.8%. The sharp slowdown this time was also largely due to pandemic, especially in large cities including Beijing and Shanghai. The Statistics Bureau says China's first half annual GDP growth was 2.5%. Since the country's growth target is 5.5% for the whole year, the second half needs to grow by 8.5% to meet that target. That will be a tough job, but there are already positive signs in June. Beijing and Shanghai have largely returned to normalcy, reopening schools and restaurants. Domestic tourism is bouncing back. One example was the thousands of Shanghai travelers swarming to the tropical city Sanya recently. International flights are recovering too, as authorities have shortened the isolation period by half for overseas travelers. Economically, the Chinese government has rolled out a series of detailed stimulus measures in recent months, cutting taxes for small businesses and encouraging more investment into big-ticket infrastructure projects. From June 1st, purchase tax for small engine cars have been halved to encourage auto sales. China also says it will promote healthy development of platform companies, a clear move to stabilize jobs. These efforts have generated positive data in the months of June. China's Manufacturing Purchasing Managers Index, or PMI, was 50.2 in June, back to expansion territory after 3 months in contraction. China's exports in June surged 17.9% annually, showing a speedy recovery to fulfill delayed export orders in April and May. China's June inflation was 2.5%, much healthier than the 9.1% in the US and 8.6% in the Eurozone in the same month. China even has the luxury to cut interest rate in the second half of the year to spur economy, while in the US and Europe can only hike rates aggressively to combat runaway inflation. A report by Goldman Sachs in early July says improving macroeconomic indicators in China means Chinese equities will be a bright spot among emerging markets, while some Chinese analysts believe Chinese stocks will outperform US stocks in the second half as the American economy is facing rising recession risks. Having said all those, risks remain in the second half for the Chinese economy. International demand may weaken for Chinese exporters. The real estate debt problem may take longer than expected to solve. But all in all, China remains one of the most stable and prominent economies in the world for the rest of the year, and especially so for the next 2 years when the world is facing all kinds of uncertainties and even recession risks.